a lot of changes going on in financial markets at the moment. Is that something to be worried about?
With where's the bigger challenge? Is it recession? Is it inflation? 7 out of 10 of the best days in the last 20 years were in bear markets. So it's not about timing the market.
Yeah.
It's about time in the market that counts.
So Ian, Trump's tariffs, a lot of changes going on in financial markets at the moment. Is that something to be worried about?
Okay, so we've seen these market disruptions, I'm going to call it that, before.
Yeah.
Okay. This time it's Trump tariffs, and I'm sure you've switched on the TV, 10 o'clock news, headline.
It's all over.
It's all over the news. And that can be worrying if you're an investor, because it's sort of 24/7, social media, Trump tariffs, and markets are moving with volatility at the moment. And that is worrying. Why is it happening? It's happening because the US president, the administration have imposed taxes on bringing goods into the US. So why they're doing that? They're doing that because they want to encourage US consumers to buy American, to buy manufactured goods manufactured in the US. And that will raise taxes and it'll create investment for the US. So it's all part of this America First policy from Donald Trump. But as I said, we've seen this before. This is not the first market disruption that's happened.
So yeah, I agree. I remember living through COVID. That's something that I remember. Just how markets performed in that period as well. There was a lot of uncertainty, and markets, it did take a little bit of a hit. Are we going through something similar again?
Yeah, let's just go back on history, because I think history is a really good way of helping us understand what's happening today for an investor. So let's look at COVID to start with. So, as you say, not a great time to live through. No. We were locked in our houses. There was concern around what that would do from a global level in terms of health, in terms of people, and obviously the economy. And one of the sort of shock events afterwards was a recession that came after all the, that was a very terrible time that COVID was. Yeah. But actually with markets fell at the start of COVID within that year, and then they rallied sharply at the end of the year. We look at the global financial crisis, the GFC 2008, and again, I don't remember, in the cities of the UK, people were lined up to get money out of the bank.
Yeah, it was that worry, wasn't it, that actually my money's in the bank, I'm going to lose it. I've worked so hard, that emotional driver for those decisions. Yeah.
And it was on the 10 o'clock news every night, the headline event, and it was market turmoil as a result of that. And that was, it was a concerning emotional time to be an investor. Yeah. I think both of those events were tangible in the sense of leading to a recession. It feels this time there's an intangible element. Because Donald Trump is the most powerful politician in the world, and the story is sort of changing every night on the TV, and the impact it might or might not have. And the president has a track record of changes his mind, and it's difficult to predict. Therefore, there's going to be a recession. Obviously, we've been here before. We've been through these uncomfortable times. We've witnessed it. On average, markets recover when they've had this market stress within 6 to 12 months on average. Okay, some will be a bit longer. I know the global financial crisis, it took a bit longer. But markets are resilient over time. Yeah. And so it's really, as an investor, you should almost be prepared when you go into investment that you're going to get some good days and you're going to get some bad days. But over time, there are more good days than bad days. Yeah. Look, I've said this before, nobody rings a bell when we're at the top of the market or at the bottom of the market. So we don't know that. Staying invested is super important, because by staying invested through the volatility, yes, you'll capture some of the down days, but you'll also capture the up days. And over a long period of time, there are far more up days with equity markets and bond markets than there are with down days. But you do get those. And so you've got to accept when you invest, you get a bit of both. Key piece of information for today is 7 out of 10 of the best days in the last 20 years were in bear markets.
Oh.
And that's when markets have fallen on the back of the sort of friction we've got right now.
Yeah. Yeah.
And that data should tell you something about how we handle volatility. You can't time the market.
No. Unless you have a crystal ball, Ian.
Well, yeah, exactly. Which nobody has.
Yeah.
Okay. So it's not about timing the market.
Yeah.
It's about time in the market that counts.
Yeah.
It's all about long-term returns and staying invested, diversification, managing risk. They are the things that are important to control those emotions we've talked about today in meeting your financial goals.
So there's a lot happening in the US. Is it just the US markets that are affecting financial markets at the moment?
No, I mean, this is a global market event, and we just think about what's happening from the US administration. They're imposing tariffs on 60 countries outside of the US, so it's a global situation. But some markets are performing better than others at the moment. So the UK, let's use that as an example. Yeah. UK had a relatively good first quarter. Why was that? We had some good corporate numbers from the UK. And there's a number of value companies in the UK, and they performed well in the first quarter of the year, better than the growth companies. The growth companies typically like the technology stocks, and of course they've fallen in value since the start of the year. So the UK has performed relatively well. Europe has performed particularly well. It was the best performing region in the first quarter of the year. Again, grappling with recession risk and tariff risk, and they're reducing interest rates, and that led to European markets performing relatively well. Right now, most equity markets are feeling it in some way. But that's a temporary action, I think. What the markets will try and do is then work out where the growth is going to come from in the near term. And I come back to the US situation, where US companies, when this sort of settles down, will US exceptionalism work? Will those US companies that are driving high growth, the technology companies, still demand a premium? Because if they do, that will feed into their market. And that will come through. But yeah, this is definitely a challenge for the globe. Let's look at emerging markets as well. And a lot of the tariffs impact Far Eastern markets particularly. So China is under pressure at the moment because of the tariffs. Yeah, let's just look what's happening behind the scenes. So do you go running?
I try.
Okay.
I try.
You've probably got a pair of Nike trainers, okay?
Yeah.
Those trainers are most likely manufactured in the Far East, okay? So what's going to happen is there's going to be additional tariffs put on those goods, manufactured outside of the US, and then brought back to the US, and that's going to make those goods more expensive, and that's what the market's worried about right now. Have you got a mobile phone?
Yeah, well, everybody does. Again, same principle, I'm guessing.
So, a lot of the tech company, the phone companies, they're manufactured and they have component parts that are made in Far Eastern markets. So again, we've seen share prices in those particular areas decline, and those particular stocks in the US decline on the back of these tariffs. But this is, again, I would say temporary action, while the market finds a level and really understands what's actually going to stay in place from the US administration, and whether there'll be any wriggle room in terms of tariff negotiations. That is to be determined.
So you mentioned there that there's a lot of impact kind of on the equity market side. What about the bond market? How is that going to be impacted?
Okay, I don't know if you remember a couple of years ago, there was a lot of press discussion around the 60-40 portfolio.
Yeah,
so 60% equities, 40% bonds. I don't know if you remember that.
Did they say it was dead, or it wasn't, not
Those portfolios are dead.
Yeah,
I remember the headlines again. Back to headlines again, and the noise. We're in a different place now. So as we've talked about, what we're seeing at the moment is share prices coming down, and defensive assets have gone up in value. Safer haven assets have gone up in value, and that's what's happening at the moment. But what drives bond prices? It's interest rate perception. So for most people, where's the connection with that? It's your mortgage. Okay, so I'm sure a lot of people are looking at their, at the financial press and online media, going, where's interest rates going? Where's my mortgage rate going? Let's just look at the US. So in the first quarter, the Federal Reserve, they sat on their hands. Yeah. They didn't do anything with interest rates. The chair of the Fed left the door open in the last meeting of the quarter, suggesting that there may be more rate cuts on the table. So what's that telling us? Okay, from back to that question, it's saying that the bond market is more concerned about the threats to growth than it is to inflation. Right. The challenge is, of course, if at the same time you've got goods, particularly in the US, that become more expensive, and here, how do you count? That's what the market's grappling with. Where's the bigger challenge? Is it recession? Is it inflation? And the market's not found that level yet, and that's why we've got that volatility that we've got right now.
So Ian, market wobbles, as a CIO, what's your defensive play?
Okay, well, firstly, don't panic.
Yeah.
Don't react to what's happening in the short term with the noise that's happening with markets. So when we're building portfolios, we're building it on long-term building blocks that's data-driven, that there's empirical evidence, that there's sort of sound academic empirical evidence that sits behind the construction of it. And there'll be a balance between growth assets, normally equities, and defensive assets, normally bonds. And when, as we're seeing at the moment, equities are coming down, but the bonds are going up. So there's a bit of cushion to this wobble that you're talking about there. And even if you've got a portfolio that is 100% equity, 100% growth assets, within that you've got diversification. Yeah. So you've got lots of different sectors, lots of different regions. So you're spreading the risk over lots of different areas. So it's not, for example, just 100% in the US, and the US is feeling the pain right now on what's happening with markets. So it's diversification is important, but not reacting is important, because in the long term, the markets will find a level, and you build your portfolios for the long term, and that's what we're doing.
Yeah, definitely, I agree. And as they said earlier on, no one rings that bell to tell you it's the bottom of the market, and that's why you almost need some more sound evidence to be making those decisions on than the media and all the the noise that comes with.
I think, in honesty, for a lot of clients, they don't need to make a change right now unless there's a change in their financial plan that means they need to change something to meet their financial goal. That might create a change, but changing their mix of investments, what's changed in the long-term goal is this, and the portfolios have been set up and structured to meet that financial goal.
Yeah.
So if you stay true to those three things we talked about of diversification, managing that emotion, and staying invested, that will see through what is going to be a choppy period, a bumpy period for markets the next few months.